Awesome. Well, we're going to go ahead and get started. And sorry for getting going a few minutes late today. Just run a little bit behind. Um, Bad joke now, but kind of like Southwest Airlines, they get off schedule, they never catch up for the day. But given all the computer fiascos they had, I feel like it's a bad joke. But, anyways, um, thanks for joining our end of Q2 market update webinar. We've got Michael Montemayor with Russell Investments back in virtually, anyways, not in person, but virtually for another one of our market update webinars. Where the hope is that we'll recap Q2, what happened, what was driving markets, kind of where we are now, and help manage some expectations for the balance of the year. There's plenty of uncertainty that is still persisting. Lots of fun and exciting events coming up, like an election, the rest of the year, in case you missed that one. So, Michael, appreciate you as always, man, taking time to be here. I know our clients seem to rave about you every time that we have you on. So, thank you for making it fun and exciting. And yeah, so thanks for being here.
Definitely, man. I appreciate the time and let me be a part of the conversation. For everyone tuning in, I appreciate your time as well, and let me for the reviews for let me come back. So yeah, thank you.
Anytime, man, anytime. So, kind of typical fashion for us, I think, is going to be I'll be the MC, and you'll have some prepared marks between our staged questions, as always, and
Yep.
it'll sound like it's just a fireside chat. So, Michael, I guess with that, maybe recap the second quarter and kind of what drove markets, what transpired, and kind of where we are now, if you don't mind.
Yeah, definitely. So let me start there. I'm going to kind of go to one of my favorite slides to kind of kick this type of recap off. And you'll see there's a lot of economic indicators on here, but just to kind of recap what we've seen this year, quarter two, I think it's a good place to start that the S&P 500 is up just under 17%. So we definitely have a solid start to the markets. U.S. companies have recorded respectable earnings in quarter one of this year, growing around 11% year over year, which was stronger than the prior quarter. So, there's more good news there. You also have the Magnificent Seven continuing to dominate the earnings and make up majority of the stock market's gains. The Magnificent Seven are also now about a third of the index, which has sort of transpired, year to date. The AI craze that I know we're all hearing about has definitely helped most of this. And if you look a little bit further into the S&P 500, this is probably not good news like we've seen overall, but the other 493 stocks were down 0.5% in quarter two, when the Magnificent Seven stocks were up about 18% in quarter two. So we're seeing a lot of this growth driven by just those seven names, which it's nice to see the markets are up, but it's also kind of not nice to see that so much of it is really being dependent on just seven stocks. Kind of changing pace to, or changing the topic to inflation. When you look at inflation, it has been trending downward since year to date, albeit there's been some random spikes in there, but again, trending downward since January. And it's right around 3.3% right now. We're going to get another reading on Thursday, so we'll hopefully continue to see that trend downwards. Another positive sign, with that kind of complementing inflation coming down, is we have actually seen volatility has been on a steady decline when it comes to markets as well. I have a chart that I'll share a little bit later that there's only been 20 days this year with a 1% move, which is pretty crazy when you think of the average is typically about 72 days a year with a 1% move. So we're looking at, very, very low volatility for the markets, which is a good thing. Bull markets tend to be pretty boring. They just continue to slightly go up and up, and we're not going to complain about that. When you kind of switch to the fixed income side of things, the 10-year yield has ranged from about 3.9% to about 4.7% this year, and it's right around 4.3% today. This is also good news in my eyes because it's allowing people to collect decent coupons from their bonds. You know, we weren't getting good income from our bonds like this for a while, and now we have, which has been nice, coming off a painful 2022 and 2023 for fixed income. However, you know, there's also some bad news to share there too, and that yield curve is still inverted, which is definitely a concern historically. And you know, again, rates have come down with some optimism around the Fed lowering rates with inflation trending downward too. So again, there's good and bad news kind of mixed in there. Another thing that I guess I'll mention too is with interest rates remaining relatively high, home prices are on the rise despite home sales sort of being down significantly from what we saw between 2020 and 2022. A lot of people are buying, a lot of people are moving. That has really slowed down because of interest rates being higher. A lot of those, you know, people were able to lock in lower rates, kind of are staying hunkered down where they are. Kind of switching to unemployment on this chart as well. There's been kind of a lot of talks around unemployment lately because it has been on a steady increase from the, you know, the 5-year low of 3.44% that we saw back in April of last year. Before we just hit a 4% unemployment mark in May, there was actually 27 consecutive months of being below a 4% unemployment, and now we're right around 4.1%. So again, you know, unemployment's still low, but it is increasing. So you can kind of look at that as maybe a slowing indicator. And then lastly, you know, you just look at GDP coming down a little bit. It was about 3% at the end of Q4 of last year. And if you start looking at expectations now between where they are now for Q4 of this year, they're between 1.5 and 2%. So again, you know, coming off solid growth, but we're starting to see some slowing down. So when you sum all of that together of what I just kind of walked through on this economic indicators dashboard, there's mixed signals there. You know, we're seeing a mix of solid growth, but we're also seeing, you know, some slowing indicators there. So to kind of recap the year so far, that's kind of what we've seen. And I think the things that stand out to me the most is obviously the markets are high, again, just up under 17%. Market volatility is low, which is a good thing. Interest rates are still paying good coupons. But again, you know, you start looking at some things like unemployment starting to steadily increase. There's areas to be excited about. There's areas to be kind of a little cautious about. So that's kind of my recap of Q2 and year to date. But Mark, curious if you want to add anything to that at all.
Before I start talking on mute. No, Michael, I think you did a good job of kind of recapping. You know, there's still a small group of stocks that continues to lead the S&P 500 higher. As a quick reminder to clients, you don't want a third of your U.S. stocks allocated to just 7 names or 8 names. And there's really one of those within the index that has really just blown away performance, and it's NVIDIA. Michael, what their stock price was up 200-300% through the first half of the year. Is that right?
Yeah, and that's a great segue to this chart. And I'll just bring this up to kind of back up some of the data that you're talking about. But you look at 2024 year to date, NVIDIA is up 149%. They're the number one stock in the S&P 500. And, you know, again, you start looking at this narrow leadership there. There's a lot in just those 7 stocks. But to your point, you just said, you know, you don't want all of your U.S. equity exposure or a third of your U.S. equity exposure coming from 7 stocks. And the reason why you probably said that is you look at years like 2022, where look at all of those Magnificent 7, they're down across the board with an average 18% return. And, you know, that good news can become bad news pretty quickly. That's why obviously it pays to be diversified and have, you know, exposure elsewhere. But yeah, to your point, NVIDIA is up 149%, and it's now the second largest stock in the S&P 500 index.
That's crazy. Yeah, yep. But I mean, as much to do as there's been about the Fed keeping rates higher, you made a great point, which is bond yields, which are great for generating income, because that in a bond investment, that's where most of your return comes from, the yield. It's not price appreciation. It's how much income you're getting from the bond. Because the Fed has maintained rates higher for longer, bond yields are higher. And so that is a good thing for portfolios because it means that yields are going to creep up and we're going to continue to see income generating ability from bonds continue to tick up as well. So, I mean, Michael, that's a pretty good recap so far of the first half of the year. So where are things right now? Do you think the market is overvalued? Do you think it's undervalued? Any sense of what the Fed is thinking? I know we have a couple things on tap this week. Unemployment ticked higher. Jobs created, I think, fell short. So I know there's been a lot of talk about inflation continuing to trend down because some of the housing costs rolling off from a year ago. Where are things now, and what's maybe the outlook in for the balance of the year?
Definitely. No, I'll definitely address that. And before I jump into that, you just mentioned, higher for longer, and how that's actually a benefit for bonds. A lot of advisors and investors have been questioning, well, what does higher for longer mean for the stock market? So I figured I'd share this chart because Russell has so many good charts. I want to make sure that we touch on a good amount of them. But to your point, higher for longer is good for bonds because you're getting yield. That most of that appreciation that you're going to see in your fixed income and return sources are going to be from the yield, which again, we're continuing to see that. But the other thing I wanted to point to is when you look just kind of going back to 1964 and you look at all of the periods where interest rates are at different rates, you can sort of see what the average 1-year return for the stock market has been and what the average 5-year return has been. So when you're kind of questioning what does higher for longer mean for stock returns, I think this is a good chart too, because this is just looking historically at interest rates right now are between 4 and 6%, depending if you're looking at the federal funds rate or if you're looking at the 10-year rate. And when you look at that, return, that rate of return or those rates that you've seen over the, going back to the 1960s, you see usually about anywhere from 6 to 14% growth over that next 1 and 5 year in the stock market. So, this higher for longer historically has actually been a pretty decent narrative. So I just wanted to touch on that since that's something that you mentioned. Now, kind of where we are today and where we are going, I think a good way to sort of approach this is, just kind of looking at the different narratives that we're kind of hearing across the country. Looking forward, a lot of people are kind of talking about, will there be a no landing, a soft landing, a hard landing? And our main outlook is that the markets at mid-year 2024 are priced for a no recession soft landing in the US, and that it's a more likely, that's more likely the case than not. But there's also sort of that mixed data signals that we were kind of just talking about, just a moment ago, that are sort of delaying central bank rate cuts. And this sort of creates some risk of a hard landing in late 2024, more so probably early 2025, which I'll sort of explain in greater detail now. But before I do that, I think it sort of makes sense to cover what these three possibilities are further, because I'm sure everyone on the call here has heard the no landing, the soft landing, the hard landing, on media. And really the receleration or a no landing case where the economy continues to do what it's doing now is more so supported by sort of the above trend job growth that we've been seeing. We've been seeing double-digit expectations for corporate earnings growth, and we're seeing record travel. We're seeing this downward trending inflation, albeit, yes, prices definitely remain high, but, we're seeing that good news there. So that kind of supports maybe a no landing case. Then there's also the potential for the soft landing period. And, spoiler alert, Russell Investments thinks the soft landing period is most likely the outcome that we see. But this really is going to be below trend growth supported by a slowdown in forward-looking labor market indicators, which we've sort of been seeing in hiring rates, unemployment, cooling in wage growth that we're seeing now. You're also sort of seeing signs of distress from low-income consumers, which we've been sort of indicated by rising default rates on credit cards and auto loans that we've been seeing now. And then lastly, there's also a case that could be made for the hard landing, recession scenario, which really relies on historical data. And when you kind of look at what we've seen and where we are now, it's no denying that the Fed has embarked on sort of the most aggressive tightening cycle since former Fed Chairman Paul Volcker in the early 1980s. The yield curve, as I mentioned before, is inverted. That 10-year rate minus the 2-year rate has been inverted since mid-2022, and this is a classic warning sign. And the U.S. economy has really never avoided a recession after that sustained period of restrictive monetary policy like we're in today. So to kind of answer that question, I think we have to look at those three main scenarios, and then you need to consider all three of those outcomes and kind of look at the probabilities. Like I sort of hinted and alluded to earlier, we believe that the no landing is sort of like the least likely outcome. And the main debate is really going to be between a soft landing and a recession, with the soft landing again being more likely than not what pans out. But we really believe this though, because there is enough evidence that the economy is slowing. You start looking at, and also inflation pressures are easing, but you start looking at households sort of having exhausted their pandemic excess savings. You start thinking about that 2023 fiscal boost from the federal government's Inflation Reduction Act of 2022. It's more so turned into sort of an economic drag. Inflation is on the way down, which should be confirmed with more data again coming in on Thursday. Furthermore, you start looking at this case for a soft landing, and it's sort of about, is the cycle different, that the normal rules don't apply, because it's sort of believed that this inflation spike was mostly due to demand recovering more quickly than supply following the COVID-19 pandemic. In contrast, previous Fed tightening episodes, households and corporate sector debt did not overborrow like we've seen in past Fed tightening episodes. And a lot of us on a household level and a corporate level have really been protected by the Fed's, rate hikes by locking in low rates on 30-year mortgages and longer-term corporate bonds, really meaning that the tight Fed policy has really been less painful than usual, which has allowed the economy to slow gradually and bring down inflation without triggering a recession. And in contrast, again, the last kind of thing I'll mention too is, there's also that case for this time is longer rather than this time is different. The soft landing could overshoot into at least a mild recession. The resilience of the economy potentially makes the hard landing more likely by sort of delaying the timing of the Fed cuts, kind of letting that slowing build up and then allowing them to finally cut. So again, when I kind of think about where the market's going, I do look at this 3 scenario lens of the no landing, the soft landing, and the hard landing that potentially could just be more so a mild recession. We think the most likely scenario is going to be that soft landing. If the soft landing occurs, we probably see some room in the markets to continue this bull market that we've been seeing. If a hard landing occurs, we probably see a slight correction, which obviously turns into a good buying opportunity. But the bottom line that we're really making sure that we voice on our opinions is, we think advisors and clients should really stick close to their strategic asset allocation targets. Don't chase the AI stock names. Don't get too defensive and go too much into bonds, because I know those yields are looking attractive, but at the end of the day, we still believe equities are going to outperform fixed income over longer time periods. So again, just some things to kind of think about is those 3 different scenarios and how those potentially pan out. That's kind of where we think we are today with all those different indicators, and what those indicators mean for these 3 different scenarios. Again, in the most likely scenario probably being a soft landing. So I'll stop there and kind of turn it back to you, Mark, see if you have any additional thoughts that you want to add on that.
Not sure I have any additional thoughts to add. Quick recap, though, what I heard is soft landing, meaning continued economic expansion is expected. Even if the Fed maintains interest rates where they are now at 5.25%, 5.5%, the economy still looks poised to continue taking positive steps forward. The Fed has done what's needed to rein in inflation, right? And so supply and demand have kind of balanced out at this point. That doesn't mean prices will go down. Just quick side note, I have found that I think in this discussion on inflation, people equate, oh, inflation is better with prices went back down. And that's not going to happen. That's called deflation. And the Fed does not want that to happen because it's a death spiral for the economy. Because Michael, I mean, if you're like me, if I know I can get a 10% discount a year from now, I ain't buying it today. I'm waiting. And so the Fed wants desperately to avoid prices going down because consumerism dries up today. Then corporate profits fall off the cliff, which means there's mass layoffs, which further drives down spending, which further drives down corporate profits, which yields more layoffs. And it's just this downward spiral for the economy. And so hate to burst anyone's bubble if you think that prices were going to go down, but probably not. But the other thing that I heard, Michael, maybe implied is that with where the Fed is, if there's continued economic growth, it probably sets up a stage for the Fed to slowly cut rates over the coming years, which bodes well for, number one, equity returns to be above average and above trend. So to your point, long-term returns for equities will outweigh or be better than, at least on an absolute basis, higher than bonds over long periods of time because you're getting additional return for the risk. Bonds, as the Fed does slowly normalize interest rates, will probably see above trend returns. As rates fall, prices will go up over the next several years, while yields have remained elevated and will slowly start to come back down over the coming years. So, I mean, other than that, did I really miss anything? Other than
you didn't. That was a great recap because I talked through a lot of different things with all these data points that we have on the screen, you know, of where we are now, basically. But no, that was a great recap.
So
Mark, what else did you want to get into today? But I also did have a couple one-off slides that I wanted to make sure that we shared with the group as well.
Sure, go for it.
Okay, so yeah, I'm gonna back up a little bit here because I do like some of these slides to kind of support what we were looking at before. Another thing I just want to kind of point out here too is, you know, when you look at how well the market has started off, like I said, you know, we're double-digit returns for the S&P 500 or high single-digit returns for a 60/40 portfolio, you know, starting this year. There's a lot going on in this chart, but what we're looking at is instead of just talking about the S&P 500 or just talking about fixed income, what we did in this chart is we actually looked at a 60/40 portfolio. So 60% equities, 40% fixed income. And it's a little bit more realistic to more so the asset allocations that all of us on this call actually have in our portfolios. I'm sure there's very few people that are 100% equities and there's very few people that are 100% bonds. Most of us typically have a mix. But when you look at that return of a balanced index portfolio going back to 1984, you'll see that first half of each year, we're kind of plotting out those returns that we've seen since 1984. And then we mark it either green or red, indicating if it had a positive first half of the year or a negative second half of the year. And what you'll see is majority of the times when you have a positive start to the year, you're going to finish with a green outcome, with a positive second half of the year outcome. So, you know, I think there's a lot of talk going about, you know, equity valuations are high for the S&P 500. When you look at an index level, you know, some people think, wow, we had a really hot start to the year. What does that mean for the second half of the year? And I think it's just good to know that if you look historically, you know, especially those years that start between that 5 to 10% second half return for 60/40, the rest of the year tends to finish positive. So if anyone's looking for a little bit of good news, I think that's definitely some good news there, that if you're in that 60/40 portfolio, history shows that we're going to have a positive second half of the year, albeit even if it is an election year. So I wanted to share that one. Any thoughts that you want to add on that one, Mark, as I kind of go to the next chart I wanted to share?
No, I think it's a great reminder that normally the way that the first half of the year goes, the second half follows.
Definitely, definitely. And to add on that a little bit, again, kind of just talking about equity valuations, I mentioned before, there's a lot of people talking about the S&P 500 hitting all-time highs. What we did is we tracked it going back to March of 1957. We just wanted to look at the S&P 500, how many times it hit all-time highs in these different decades. And you'll see, the 2020s has definitely been higher for the S&P 500 hitting all-time highs. We continue to see all-time highs being hit year to date in 2024. So what we also wanted to look at is when you look at these S&P 500, the S&P 500, and we look at the following 1 year rolling periods, the following 3 year rolling periods, and 5 year rolling periods, when you look at these all-time highs, you're going to see that anywhere from 69 to 86% of the time, the market continues to go and hit positive returns over those 1, 3, and 5 year periods. Albeit, yes, there's also 14 to 31% chance that we've seen negative returns over the following 1, 3 year, and 5 year periods. But I just think it goes to show that there's a lot of possibilities. But I think we need to focus more so on the probabilities, and the more probable outcome is probably going to be continuing to see positive results after hitting these all-time highs in over 1, 3, and 5 year periods too. So again, just kind of historically speaking, the market goes up more than it goes down. So a lot of the times it's going to trend towards positive outcomes. But I think it also is good to note when we're coming off these all-time highs, it also tends to be an indicator that that bull market continues to have steam and continues to push forward as well. So anything you'd like to add on that one, Mark?
Maybe just a couple thoughts. And Michael, I don't know if you and I had this conversation or if it was a conversation with somebody else, but a stat that has generally kind of stuck with me is that about 86 or 88% of the time, the market is below its all-time high. So just because it hits an all-time high doesn't mean it continues on this linear path up, right? It'll hit the all-time high, pull back, and then work its way to get back up till it hits another new high. And anytime that there's uncertainty or events that will drive uncertainty, election in 3 months, 4 months, 3 to 4 anyways.
Yeah.
Markets will likely pull back in advance, await the outcome, and then march higher once there's certainty for the next couple of years. So, Michael, I think that this graph is great because it takes all of that short-term volatility into account. And 1 year after the all-time high, 69% of the time, the S&P is higher.
Yep.
A third of the time, it's lower. 3 years after, 5 years after, again, the predominant result is that over a longer period of time, equities end up higher. Certainly exceptions to that. 2000s, we had 3 years in a row where markets were down. We had 08 mixed in there. The 70s, again, the era that right now is being compared to a lot with inflation where it's been. So appreciate the reminder.
Yeah.
Is maybe as I kind of stall for a few minutes for any questions from clients, is there anything over the balance of the year, and I touched on the election, that we need to have our eyes open or need to be focusing on, that our clients can maybe try to tune into and help cut through what the news media and the headlines will yield? Anything over the balance of the year to really be focusing on?
So you mentioned this before, and there's a couple things that I would also add to this, but obviously the big one, the big elephant in the room is election is coming down. We're about a quarter away from the election. So one thing I'll mention is, as the election starts to heat up, we obviously just had the first debate, and there was a lot of media press around that, and there's a lot of speculation of what's going to happen for the rest of the year. We're going to continue to hear about this, and we tend to see a lot of people go to cash in election years. But what I think would be good to put everyone put in their back pocket is when you look at election years going back to 1976. This isn't just the S&P 500. We're looking at a 60-40 portfolio going back to 1976. If you look at every election year for that 60/40 portfolio going back to 1976, you're looking at majority of the returns are positive. 11 of the last 12 election years, the 60/40 portfolio is finished in positive territory. The average return for that 60/40 portfolio going back to 1976 is right around 9.7%. And the negative occurrence that we see here was sort of driven by the bursting of a historic housing bubble that we saw in 2008. So obviously we need to be more so in tune with what's going on with the economy versus what's just going on at the polls and with the election. So again, as those conversations sort of heat up, I definitely would sort of keep this in mind that election years actually tend to be positive years for a 60/40 portfolio. The other thing that I would mention too, and I don't really have a slide on this, but we're hearing about more polarization of just the world, and you hear about obviously wars going on overseas. If we see anything more kind of advanced there, there could be some volatility, but I think a lot of that's priced in. A lot of things aren't really surprising markets going forward of kind of how we've sort of been, in tune with what's sort of been coming about of the wars that we've seen across seas. If we did see a surprise there, there could be some potential volatility. And then I guess the last thing I'll mention too is, we're obviously going to hear a lot about taxes and tax changes potentially going on. This also, sometimes will get some people a little bit hesitant about investing. And the Tax Cut and Jobs Act that was put in place in 2018 is on the chopping block for 2026 of potentially, sunsetting, potentially going away. And I don't have to go through the Tax Cut and Jobs Act. All I know is that there's a lot of things changing. A lot of our brackets have come down. Standard deduction basically doubled for most investors. We had a massive estate tax exemption kind of jump there. Net investment income tax, long-term capital gains rates really haven't changed. So my main messaging here is that taxes are always going to be a headwind, even if we don't see them go down. But if you do look historically, when we have seen tax rates increase, I know a lot of people think that's going to be sort of impactful on the economy, impactful on the markets. Historically, going back to, and I don't have the chart for this, but we've run a chart like this in the past, when we do see tax rates potentially go up, it's actually seen, again, majority of the time we've seen positive returns for the market. So, if we do start to see some talks about tax rates going up, I think the more important thing is to make sure that you're positioning your portfolios as tax efficient as possible, but staying invested because it tends to be a positive return situation for markets as well. So I guess those would be my three things: elections, geopolitical risk, and I know we're going to be hearing taxes and more about taxes in the news, which again hasn't been a horrible thing in markets historically.
So, in summary, elections aren't anything to run away from. They happen general elections 4 years, midterms keep us every 2 years.
Yep.
There's volatility, but stay focused on the long term, right?
Definitely. Yep.
And last I checked, markets don't care about R or D at the end of the day.
Yeah.
I know we all have our deeply held political beliefs on what we think would be best for the country. But maybe putting that lens aside and focusing on the fundamentals of the markets, Wall Street just wants clarity at the end of the day on what is the risk that there could be a departure from what we know today. And once the election is over, then usually volatility settles down.
Yep.
And that gives Wall Street a little bit more clarity and sense of direction for the next 2 years anyways. And the best outcome is for divided government because it means little risk for departure from what we know today. So some combination of R&D at the end of the day is what markets like the best, whether that's from the executive down to Congress, RDD, RDR, RRD, DRR, DDR, and if I missed one, I'm sorry.
There's so many potential outcomes. But yes, divided and a good mix of it all is usually what we see do best for markets. But again, you look at all outcomes and you look at all outcomes that have ever occurred going back to, the early 1900s, and there's only two or three, combinations of RRD or DRD, like you were just talking about, that ended up negative. And they were during times of, 2000 to 2010 when the market was sort of flat. You also have the 1970s where markets were very volatile. So it was more so what was going on with the economy, not so much that it was that makeup of that RDR, DDR, or however you want to kind of look at it as well. So, but no, I'll just second all that you said, Mark. One last slide before we kind of open it up for questions. I thought this would be a fun one to include. It's, the Olympics are going to be starting pretty soon. I know that a lot of us have been seeing some of that stuff on TV already. So there's been 40 years of Olympics and market returns, kind of just going back to 1984. I just kind of want to look at, the sprints, the middle distance, and the long runs. And you'll sort of see we kind of made it a fun chart that kind of, relates to the Olympics, but we looked at cash versus stock and bonds and versus just bonds itself. And for the stock and bonds, we're looking at a 50-50 portfolio. So it's 50% stocks, 50% bonds. And you'll see when you look at the 1 year positive percentage, cash is positive 100% of the time on a 1 year rolling basis. Now, when you look at second place, bonds are positive 87% of the time on a 1 year rolling basis. And then stocks and bonds, that 50-50 mix, they're positive 86% of the time. So yes, cash takes gold in the sprints when you think about 100% positive outcomes. Now we start getting to middle distance, 5 year positive returns. Cash is still 100%, positive most of the time. Stocks and bonds takes second place with that 50% bonds, 50% stocks being 99.5% of the time positive outcomes over 5 year rolling periods going back to 1984. And then bonds takes third place with the bronze there at a 98.6% positive outcome. Now, we all know that many of us have different time horizons, but most of us are investing for the long runs. And when you look at the long runs there, that 20-year rolling minimum return, we're just kind of showing you the absolute worst return over those 20-year rolling periods going back to 1984. There's only so many of them, but the stock and bonds do the best. They get the gold medal at a 5.3% minimum return for those 20-year rolling periods. And then bonds finish second at 2.8%, and cash finishes 1.2% in third. So just kind of looking at the top of this graph, yes, cash is going to be the most positive outcome in the shorter time distances. But once you start moving to the middle distance and the long runs, that's really where, that stock and bond mix is going to help outperform and deliver a better return, even if we're looking at the 20-year rolling minimum returns that we've seen for those asset classes. So again, just a fun chart with the Olympics coming up. Over the long run, those stocks and bonds are going to take the gold. In the short run, obviously cash is going to take gold. So it's having that good mix and making sure that your portfolio is aligned with your timelines and your time horizons. So hopefully that was a fun chart that kind of can add to the Olympics and kind of what we're just reminding people, to stay invested, stick towards those strategic asset allocations, mute the news a little bit, and to kind of just stick to the plan.
No, I like the chart, Michael, especially with in the spirit of the Summer Olympics coming up. So,
yep.
Anyways, well, I don't see anything in text chat or Q&A, man. So I guess with that, we can wrap up. As always, appreciate your time and insights and helping to just cut through kind of the static and chaos that I know is the news media and everything else. But really appreciate you taking the time, Michael, as always.
Yeah, thank you, Mark. I appreciate you letting me be a part of the conversation today. Hopefully everyone on the call is walking away with some good information and some good charts and pictures and graphs. And Mark, I'll send over these pictures over to you If anyone wants to see them and kind of flip through them, they're more than happy to. And if any questions come up, I'm always a call away too, as a business partner of Mark's. So again, appreciate the time today.
Thanks, Michael. Appreciate you. We'll talk to everybody soon, and thanks for joining in today.